The race to build artificial intelligence infrastructure is raising red flags for financial experts. The credit rating agency Moody's warns that massive spending on new technology could threaten the financial stability of top corporations like Amazon, Meta, and Alphabet. Their report shows that building vast physical data centers is forcing these companies to take on unprecedented levels of debt. Moody's projects that industry investments will reach nearly $1 trillion by next year. This shift away from low-cost software marks a major change for Silicon Valley, potentially putting their historically strong credit ratings at risk as they borrow heavily to fund ambitious expansion plans. Investors are bracing for a potential shock as United States interest rates continue to drift higher. Analysts warn that the stock market is completely unprepared for the possibility of a 6% yield on the 30-year Treasury bond. While rates have been steadily climbing, a surge to that 6% mark could trigger widespread impacts well beyond the government bond market. Higher long-term yields make borrowing more expensive for companies and often make stocks less attractive compared to guaranteed government returns. Experts caution that this upward trend will also put significant pressure on popular investment funds, signaling a potentially turbulent period ahead for major financial portfolios. The Federal Reserve is not the only player controlling your borrowing costs right now. Bond investors are also pushing up interest rates for everyday consumers. Many common loans, such as 30-year mortgages and auto loans, are tied directly to 10-year United States Treasury bonds. As investors demand higher returns due to inflation fears, these bond yields have reached their highest levels in over a year. Consequently, mortgage rates have climbed above 6%, making it much more expensive for families to buy a home. Economists warn that this trend will slow down consumer spending as households face a tightening financial squeeze from higher borrowing costs across the broader economy.